Corporate Finance Core, Topic 5, NPV and IRR, and other investment decisions or measures. Learning objective number 5. Since we've done our analysis, we calculated unlevered and levered cash flows and talked about all our measures. We want to know what measures are used in practice. Here's a survey of CFOs from Graham and Harvey and the Journal of Financial Economics. And what they found is basically IRR and NPV are used by 75% of the respondents. Payback period is next with 56%, and then followed by accounting return, discount payback, and profitability index. So my impression is everyone that calculates NPV also calculates IRR. It's the same data. Why not get both measures? And then also I will use my payback method and others as maybe a supplement. So it's a question of what techniques are used. And again, I've done this for a couple corporations, and we generally do NPV, IRR, and payback. One thing I do want to mention is firms often limit capital budgets. So what that means is in an organization, you might have a budget for CapEx. It's called the capital budget. So how much money can we spend on long life on projects this year? Not just operational expenditures, capital expenditures. So an organization might have a budget, say $10 million is what we're going to spend out of our cash flow for capital expenditures for different projects. And so the first step you might do is you might solicit all input and try to generate as many possible investment projects as you can think of. And so when I did this for a couple Fortune 50 companies, we might have a list of say 20 or 40 projects we're looking at this year, sometimes more. And we'd have a budget. This is how much money we can spend. What generally would happen is we'd have lots of projects with positive NPVs or lots of projects with very high IRRs, which are exceeding their benchmark hurdle rate. So the question is, what do you do if you are if you limit your capital budget? You have a limit on capital budget. Even so, you have $10 million capital budget. That's what the organization decides it wants to spend. But you have $100 million of projects. The basic answer is this: you want to choose the sum of the projects that add up to your $10 million budget to have the highest NPV in total. So what projects that cost $10 million have the highest NPV in total? And the reason why NPV is always the best is because NPV is in dollar terms. It tells me in present value terms how much wealth I've created for my owners. If you want to maximize IRR, that's a little bit different. You're trying to maximize the rates of return. However, our shareholders get paid in dollars, not in rates of return. So I'm going to always go for the set of projects that have the highest NPV.